The Philippines has dollar reserves slightly down in April.
The Philippines is a nation that flourishes with a strong foreign reserve deposit held within the central bank of the country.
Now let's go to the Philippines, where its central bank will meet on Thursday. It's unlikely to raise rates this week as the country looks to keep its economic recovery from the pandemic on track.
The foreign reserves of the Philippines are making waves on the international stage. The country's massive $104 billion in foreign reserves has made it one of Asia's most financially secure nations. Today's Philippines is vastly different from its pre-World War II economic state. Its substantial foreign exchange reserves speak to the strength of its economy. But why are foreign reserves so important? Let's find it out. After suffering through a terrible debt crisis, the country's foreign reserve holdings are being celebrated as a tremendous victory. Over 70% of GDP was held by the Philippines in the 1980s, making it one of the most indebted nations in the world. The country could not have recovered without the help of other nations and the International Monetary Fund. Foreign exchange reserves of the Philippines are among the world's largest as of March 2023, at roughly $104 billion. The building of these reserves is due to a combination of settings. First, the economy is robust and has shown steady growth over the previous several years. Multiple reasons have contributed to this expansion, including healthy domestic demand, increased government expenditure on infrastructure, and expanding service industries. The Philippines' foreign currency reserves have increased as a consequence of the influx of international investment. Second, the number of Filipinos working outside the country is huge and expanding. Remittances sent home by these employees have become an important source of foreign currency for their home nation. The total amount of money sent home by overseas workers in 2021 was $33.8 billion, an all-time high and an increase of 3.9% from the previous year. The country's foreign reserves have been boosted by the consistent inflow of foreign cash. The government's emphasis on infrastructure development has been a primary factor in the country's economic expansion. The Build program was introduced by the Duterte government to stimulate economic expansion via the construction of transportation hubs, including motorways, airports, and trains. Because of this, not only has employment been generated and economic activity increased, but international investment has also been encouraged. The Philippines' economy has benefited from the world's generally positive economic circumstances, especially the continued decline in oil prices. As a result, the country's foreign reserves are under less strain, and its import bill has decreased. The Philippines now has more financial clout and negotiating ability on the international scene because of its large foreign exchange reserves. Government and private sector borrowing rates have dropped as a result of the country's improved credit rating from major credit rating agencies due to its healthy reserve position. Additionally, the country's foreign reserves make it more appealing to international investors and corporations as a safe and secure site to set up shop. But even with its large foreign currency reserves, the Philippines continues to struggle economically. Major obstacles to the country's economic growth and development include poverty, inequality, and a lack of infrastructure. The COVID-19 epidemic has also shown the country's healthcare system's weaknesses and the need for more funding for healthcare facilities and services. The country has enough foreign reserves, but there are problems too. The $98.976 billion in foreign reserves the nation had at the end of August 2022 was the lowest level in 2 years, but one economist still sees it as a solid safety net for the local currency. According to Rizal Commercial Banking Corporation chief economist Michael Ricafort, who cited data from the Banco Centraling Pilipinas released on Wednesday, the decline in the gross international reserves was caused by the government's net foreign debt payments, possible foreign exchange intervention by the central bank, and the lower value of the central bank's gold holdings due to the drop in the price of this commodity on the international market. However, he noted that GIR is still 8.3 months of imports, which is much over the minimal international requirement of 3 to 4 months, and so may potentially offer a larger support on the peso currency market against any speculative assaults. For the 6th straight month, the country's GIR level fell in August from $99.84 billion the previous month. The $107.96 billion from a year earlier is a greater level. According to Ricafort, the country's foreign reserves dropped to $108.79 billion at the end of 2021, a decrease of $9.8 billion. The decline in the GIR somewhat correlated with the weaker peso in recent months, he said. But Ricafort reported that on September 7 of last year, the local unit set a new intraday record low of 57.33. At its present rate of decline, the peso is weaker than it has been versus the US dollar since the fourth quarter of 2004. According to experts, this is due in large part to the Federal Reserve's decision to keep raising interest rates, which has strengthened the dollar. Despite the country's GIR falling, Ricafort is hopeful that it would rise again in the next months due to increases in remittances from Filipinos working abroad over the holiday season. Revenues from the business process outsourcing industry, FDI, and tourism have all increased, with the latter benefiting from the country's reopening to international visitors. He continued, at $99 billion, GIR is still relatively high and could help strengthen the country's external position, which is a key pillar for the country's continued favorable credit ratings for a second straight year, mostly at 1 to 3 notches above the minimum investment grade, a sign of resilience despite the COVID-19 pandemic that caused downgrades in other countries around the world. The economic situation of the Philippines are safe because of its reserves. If we compare the Philippines with other countries, then the country is far away. Let's take a look. The Philippines' foreign reserve holdings are less than those of Taiwan and Malaysia. The foreign reserves of the Philippines were over $104 billion in March 2023, while those of Taiwan were around $542 billion, and those of Malaysia were around $122 billion. The disparities in nations' foreign exchange reserves may be attributed, in part, to the ways in which their economies are structured. Both Taiwan and Malaysia benefit from an export-driven economy and have been able to amass significant quantities of foreign currency as a result. The Philippines, on the other hand, benefits from a more diverse economy, with contributions from service industries and the agricultural sector. The amount of a country's foreign reserves may also be affected by its political stability and policy climate. Both Taiwan and Malaysia are able to attract international investment and produce foreign cash because of the stability of their governments and the ease with which they may do business. The Philippines' economic climate has improved greatly in recent years. Although it may still need more work, there is hope for ongoing prosperity and the building of foreign reserves in the Philippines, despite the fact that the country's foreign reserves are now less than those of Taiwan and Malaysia. Deteriorating current account deficit. The rising price of global oil and gas was a major contributor to the substantial worsening in the current account deficit for calendar year 2022, a year in which imports rose sharply. As the economic recovery and increasing oil prices drove up imports, the Philippines Central Bank, the Bangko Sentral ng Pilipinas, revised down its current account prediction for 2022 to a deficit of $20.5 billion, or 5.1% of GDP in December 2022. The March 2022 forecast for a current account deficit of $16.3 billion, 3.8% of GDP, was significantly reduced. The latest GIR level represents a more than adequate external liquidity buffer equivalent to 7.5 months' worth of imports of goods and payments of services and primary income, the BSP stated. To add insult to injury, it is also approximately 6.1 times the country's short-term external debt based on original maturity and 4.1 times based on residual maturity, it said. In addition, the regulators said that the national government's net withdrawals of foreign currency from its deposits with the BSP to satisfy its foreign currency debt obligations and pay for its different expenses were the primary cause of the GIR's fall in February. Downward adjustments in the value of the BSP's gold holdings due to the decrease in the price of gold in the international market, it said. The foreign reserves are enough for the country as it's very low if compared to other neighboring countries' foreign reserves. In conclusion, the Philippines' economic development is due to numerous reasons, including its foreign reserves, the government's infrastructure program, the BPO industry's rise, and a youthful and increasing population are just a few of the reasons that have boosted the economy. This was all about the Philippines. I hope you liked this video. Make sure to like this video and subscribe to our channel. See you in the next one. Till then, stay safe.